you're probably going to assess what is going on. You have your what is going on in that day. You can see that we had an open right here, and if the one of the nice things about the candle is that you can see the action during the day. If you have an intraday charting service, you probably will follow this action, but you can see where it opens there and it closes higher, which means it was it closes higher there. It was in an uptrending mode during the day, and therefore you kind of have to take a look, anticipate a little bit, is this a good place to get in or not? There may be days when it opens outside that range. You don't want to have anything to do with it, but in this situation, the market performed as it should have and moved up during the day. Also, when you look at those candles, you'll see that on this first potential trade here, you had the neural index was at 1, which was a bullish indication, and you had the predicted differences starting to make a turn, crossing over, and moving to the upside, all indicating that we had a potentially bullish scenario shaping up here after this little decline had occurred. All right, let's get rid of some of these arrows on here, talk a little bit about what we're going to do next. As I mentioned, because of the predicted lows, we have a point at which we can place a trailing stop $10 below the predicted low once we get out of this initial area here where we talked about getting into the market. At some point, as is quite often likely, we're going to have that trend come to an end. Nothing is going to last forever, so you're going to have to figure out what are you going to do when it gets to that point. In this particular case, we had a situation here on April the 12th where the market was starting to exhibit a little bit of negative because of that candle. It opened higher, but then it kind of faded during the day and closed lower than the high. So doesn't mean it's all over. It's still starting to happen. But if you'll then look down below, you'll see that the predicted differences had already started to turn down. That was kind of a negative. One of these days, it's not a very good indication, but the neural index went to 0. So several things were starting to come together that suggested that we better do something about protecting the profit that we had in this situation. So in this case, with the predicted high or predicted low being rather where it was, the predicted low on this particular day was actually we went with the highest predicted low, which was at this point right here. And so what we wanted to do was set a stop $10 below the highest predicted low. That predicted low was at 11.52, so our stop is going to be at 11.42. Because of the market action, we're giving it a little leeway here. We're going to let it kind of, we don't get faked out of a move before it's ready to turn. It's going to take a few days before that actually occurs, before it is hit, and then it does get hit on that long black candle, and you are out. In this particular case, on this trade, where you got in, where you got out, you were out at 11.42. You had gotten in, if you remember, at 11.08. So in that case, you had $34 in this trade. Isn't too bad to pick up on a partial move of the trend or a partial trend in the gold market. There are a couple of other potential trades in here. We won't talk about them in great detail, but there was another trade that we had, and you can see here where you might have gotten in this particular trade right about in this vicinity right here. It would have probably been bumped out right here, when the market dropped below. So that's another trade. Then you would have come right back in on this one and come out about somewhere in this vicinity right over here where you would have been stopped out on that trade as the market dropped below the predicted low by that $10. Again, we're talking about the highest predicted low, because we want to give it, again, a little bit of leeway, a little bit of flexibility, particularly since we are now working with the market's money and have made some nice profits. Well, just to get now to the most recent action, as we mentioned, our bias is the long side. Now there is another possibility that you could trade, and it depends a little bit on the type of trading you like to do. But if you said, okay, you looked at all the indicators. You looked at this. You looked at the predicted differences being down. You look at the narrow index at 0. The moving averages have turned down. The predicted moving averages turned down here, and there is a possibility that if you were very nimble and so forth on this particular candle, this long black candle, you might have said, well, if the predicted high is at this stage, maybe what I'll do is I'll just kind of fade that predicted high because that's probably the highest it's going to be today, and I'm going to sell at that high and then let the market go down and take it out at the end of the day or with a stop, trailing stop, something like this on an intraday trading basis. Uh, that's very, another possibility. We have talked about that was in some other webinars with Vantage Point, but that is a possibility you could use. This is a case where the market dropped quite dramatically, something like $30 or so. And this is one of those cases where the market does something dramatic like that. I call it a gift horse. What they say, don't look a gift horse in the mouth. If it happens, take the trade, put it in your pocket. Even though you might do better over the long run, it's better to take a gift horse, or a bird in the hand is better than two in the bush, or whatever you want to say about it. But to take some profits when you get those unusual situations, and probably sit out a little bit because it's a pretty volatile type market. Sometimes the best thing is to not trade the volatile market because it may do more to your account than you can possibly withstand based upon the size of your account. Now just quickly to look at a more current situation we had on May the 24th, we had a predicted high on this particular day of 1188, which means we would buy at 1198. That 1198 mark came probably more right in this vicinity right here that next day, and you would be long at 1198, and then you would be riding the market up, and of course as occurs, as you can see on this chart, at some point right in this vicinity right here where you have that long black candle, it would have stopped you out $10 below the predicted low. So you would have been out in this case with a smaller profit, but still a profit, something like $8 or so, or $800 if you had a full-size contract that you were trading. The most recent situation, of course, is that when you got stopped out there, then you would have probably tried to come back, using this particular type of strategy. High here just a couple of days ago, where the market was predicting a high a few days ago of, let's see, what would the high have been? 12.19. So you're buying at 12.29. Market made a nice run. You got filled real, same day. Again, it's one of those situations. You watch the market action during the day, and when you can see that it moves above that predicted high, and coincidentally above this previous high that you see over here, probably a chance for you to go long again. A couple of mitigating factors here that might have, made you a little cautious. Number one, you were approaching the previous highs. That's always kind of a bit of a danger signal. As I mentioned earlier, also, number two, you had this candle here that potentially could be a doji